So,
आ गया सर हम।
the meaning of interest rates. So, actually, the interest rate is the price of money. So, interest rate is just as the price of the money. It is the payment made by the borrower to the lender for the use of money over a period of time. Interest rate basically expressed as a percentage of the principal. Suppose I just say an example, if you borrow 1 lakh rupees at 10% annual interest, you must pay 10,000 after 1 year. This is our interest. So if we talk about the interest rate structure, so basically interest rate structure refers the pattern of interest rate prevailing in our economic across. That is different types of loans: home loan, educational loan, car loan, personal loan, is a credit card loan. Next important parameter, different duration: short term loan, mid term loan, long term loan. And next criteria is different categories of borrowers, that is the corporate loan, individual loan, government loan. Suppose think of a restaurant menu. Different dishes have different prices. Similarity in finance, different types of money lending have different prices, that is the interest rate. So then what are the types of interest rate? There are many types. The most important type and the most basic type is gross interest. So what is gross interest? Basically, the total amount paid by the borrower including pure interest plus service charges plus risk premium plus administrative cost. That is our gross rate interest. Example, suppose bank loan at 12%, 1% processing fees, 0.5% insurance charge. So the gross interest will be 12 plus 1 plus 0.5, that is 13.5%. What is net interest rate? The actual earning of lender after deducting the cost from the gross interest rate. So that is the net interest rate equal to gross interest rate minus the charges oblique the cost. Suppose gross interest rate 12%, bank charges 2%, so net interest rate will 12 minus 2%, that is 10%. So what the difference between gross interest rate and the net interest rate? So at first, gross means interest plus fees plus premium. Net means only pure return. Gross actually seen by the borrower, felt by lender. This is the gross. Then come to nominal interest rate. What is nominal interest rate? Nominal means the definition of nominal interest rate, the stated rate without considering the inflation. Simple. Bank fixed deposit, that is 7%. That is nominal interest rate. But what is real interest rate? Adjusted for the inflation, shows the actual gain in purchasing power. So the formula real interest rate equal to nominal interest rate minus inflation. Suppose your fixed deposit rate is 7% and your inflation rate is 2%. So the real return equal to 7% minus 2%, that is 5%. So this is the basic difference between nominal and real. So nominal not adjusted for the inflation, but real adjusted for inflation. Basically nominal seen in the contracts. When you just present on your bank outlet, the bank shows you that our fixed deposit rate is 7%. That is nominal. But the real rate minus inflation, that is your actual purchasing power. So real interest rate basically used in economics. Nominal interest can be misleading, but the real interest rate shows the true picture. Next, we come to the another type of interest, that is differential interest rate. So what is the definition of differential interest rate? Basically, charging different rates to the different categories of borrowers for socio-economic reasons. Suppose, just show you an example, the lower rate for the farmers, lower rate charge for the MSME sector, lower rate for charge for the students, and higher rate charge for the personal loans or the credit cards. When you take a loan for your house building, that rate will just low as compared. You suppose you borrow a loan for purchasing a car. So the car loan interest is higher than your home loan interest. And if you just borrow a certain amount of money as a personal loan, the interest will just the higher as compared to the car loan. So why do you think the government wants the farmers to get loans at cheaper rates? To support the agriculture, to support the rural development. This is our basic thing. This is not a luxury item. This is our necessity item. Then we come to what are the causes of variation in interest rates. The interest rate basically differ due to some multiple factors. Number one, demand and supply of the capital. That is a high demand for loans plus low savings, that is high rates. Low demand plus surplus of funds, that is the lower rate. Inflation, if prices are rising, the lenders demand the higher interest rates to product returns. The risk borrower, unsecured loan higher rate, secured loan lower rate, maturity period short term versus long term. Long term loans may carry the higher risk premium. Liquidity of the condition, if the economy has the abundant liquidity, that rate will fall. If the liquidity is tight, then the rates will raise. Government monetary policy, RBI uses repo rate, reverse repo rate, CRR, that is the cash reserve ratio, SLR, to influence the rates. Next, the international factors plays a vital and crucial roles. That is a global interest rate, foreign investment follows the effect of Indian rates. So these are the main thing of the variation of interest rates.